In this video, FATCA versus FBAR, key differences explained. Today we're diving into two reporting requirements that every American with foreign accounts needs to know about, FATCA and FBAR. These terms often get confused, but they serve different purposes and have different rules. If you're wondering what the differences are, you've come to the right place. Let's break it all down. So what are FATCA and FBAR? Let's start by defining these terms. FATCA stands for the Foreign Account Tax Compliance Act. It's a U.S. law designed to prevent tax evasion by U.S. taxpayers with foreign financial assets. FATCA requires you to report foreign financial assets to the IRS through Form 8938, which is filed with your annual tax return. Okay, it's filed alongside your tax return. The FBAR stands for Foreign Bank Account Report. It's part of the Bank Secrecy Act and is meant to track U.S. citizens with foreign financial accounts. The FBAR is filed with FinCEN, the Financial Crimes Enforcement Network, not the IRS. Okay? So although both laws deal with foreign financial assets, they have distinct requirements and serve different purposes and are filed with different organizations. Now let's talk about the thresholds for filing. One of the key differences between FATCA and FBAR is the filing thresholds, meaning the minimum amount of foreign assets or accounts you must have before you're required to report. The FBAR filing threshold. So with FBAR, you need to file an FBAR if the aggregate value of your foreign financial accounts exceeds $10,000 at any point during the year. It doesn't matter if you have one account with 11,000 or 5 accounts that total over 10,000, the combined value is what counts. So if you have one account at 6K and another account at 6K, you still got to file FBAR because overall combined, it's more than 10K. And by the way, the annoying thing is they haven't raised that 10,000 number in many, many years. So it hasn't really been going up with inflation. So write your congressman or something because they really got to up that number. FATCA, the filing threshold for FATCA is higher and also a bit more complex. It varies depending on your residency and your filing status. So if you live in the U.S., you need to file Form 8938 if your foreign financial assets exceed $50,000 at the end of the year or $75,000 at any time during the year. If you live abroad, however, the thresholds are higher, $200,000 at the end of the year or $300,000 at any point during the year for single filers. Okay? So if your foreign accounts and assets are under 50K, you might not need to file under FATCA, but you could still be required to file an FBAR, okay, if they exceed 10K. So what needs to be reported? Let's talk about what you need to report. For the FBAR, FBAR requires you to report all foreign financial accounts, which includes bank accounts, brokerage accounts, mutual funds, certain foreign pensions and retirement accounts, and any account where you have signatory authority, even if it's not in your name. Okay, so FBAR is more about accounts, bank accounts, checking accounts, savings accounts. And then FATCA, on the other hand, covers a broader range of foreign financial assets. So in addition to the accounts reportable under FBAR, FATCA also requires you to report foreign stocks, foreign securities not held in a financial account, foreign partnership interests, foreign hedge funds and private equity funds, and any other foreign financial instruments or contracts with non-U.S. persons. And I think it also covers any real estate, that's over 200K, but got to double check that one. So in short, FATCA covers everything FBAR does and more, especially when it comes to investments held outside financial institutions, okay? So FATCA is more than just bank accounts, where FBAR is mostly about bank accounts. So where and how to file. Another key difference is where you file these reports. FBAR is filed with FinCEN, not the IRS. It's done electronically through FinCEN's BSA e-filing system, separate from your tax return. The deadline is April 15th, but there's an automatic extension to October 15th if you miss it. So I guess it's October 15th. Okay? And it's pretty easy to do, by the way, the FBAR. You could honestly file it yourself. You don't have to pay anyone to do it. And then FATCA is Form 8938. It's filed directly with your annual tax return, meaning it goes to the IRS. There's no separate electronic filing system. It's just another form attached to your tax return, and it's due when your tax return is due. Okay? Let's talk about penalties for non-compliance. So penalties for failing to comply with FATCA and FBAR are severe, honestly crazy severe, but they differ in their amounts and enforcement. So let's go over that. So the FBAR penalties, if you fail to file the FBAR, the penalties can be steep. For non-willful violations, you could be fined up to $10,000 per violation. For willful violations, the penalties can be as high as $100,000 or 50% of the balance of your account, whichever is greater. And I remember hearing a story about a Canadian lady who, she's like a Canadian-American dual citizen. She sold a property in Canada. She kept the money in her Canadian bank account, and she didn't file her FBAR. And she had, like $500,000 or something in the bank account from selling the house, and she didn't file it. And so the U.S. government came after her for 50% of the balance of the account, like $250,000. I kind of made up numbers there, but you can look up, there are stories like this. You can probably find them. It's nuts. So FBAR is something you really want to be on top of. The next one is FATCA penalties. So failing to file Form 8938 under FATCA can result in a $10,000 fine. If you continue not to file after the IRS requests the information, the penalty can increase by $10,000 for each additional 30-day period of noncompliance, up to a maximum of $50,000 of fines. So as you can see, both FATCA and FBAR, the penalties are no joke. So it's important to stay compliant with both FBAR and FATCA. Let's also go over some common misconceptions real quick. So as you've probably learned by now, FATCA and FBAR are not the same. They are different in terms of thresholds, what's reported, and where the information is filed. Always check if both apply to you. Next, there's a misconception that you'll be taxed on everything you report. So reporting your foreign financial accounts or assets under FATCA or FBAR does not necessarily mean you'll owe additional taxes. These laws are primarily about reporting and transparency. However, failing to report can lead to hefty penalties. Okay, so both of these things are more about reporting than they are actually about additional taxes. So there you have it, the key differences between FATCA and FBAR. If you have foreign financial accounts or assets, it's essential to understand these reporting requirements and stay compliant to avoid any potential penalties. Remember, FATCA has higher thresholds and covers more types of foreign assets, while FBAR is focused specifically on foreign financial accounts. If you found this video helpful, be sure to give it a thumbs up, hit that subscribe button so that we can reach a wider audience and help educate Americans abroad, right? And subscribe to the channel for more tips on international finances and taxes as an American, as an expat, digital nomad, or retiree. And if you have any questions, drop them in the comments and I'll be happy to answer. And check out the other videos on our channel. specifically about Americans abroad, check out the podcast as well, and we'll see you in the next video.